So when it comes to acting, we think of Mr. Amitabh Bachchan, Shah Rukh Khan, Amir Khan and others. When it comes to cricket, we think of Sachin Tendulkar, Virat Kohli or MS Dhoni. But when it comes to investing, and that too stock market investing, the first name that comes to our mind is that of Mr. Warren Buffett. Such is the legacy and influence of Warren Buffett's investing style and his investing philosophy on the billions of people across the globe. Mr. Warren Buffett's net worth is 112 billion US dollars as of June 2023, making him currently the 6th richest person in the world. But mind you, Mr. Warren Buffett hasn't always been one of the richest person in the world. Warren Buffett didn't even become a billionaire until he was 50 years old. In fact, 99% of Warren Buffett's net worth was earned after his 50th birthday. But because he started investing at a young age, buying his first stock at the age of 11 and his first real estate investment at the age of 14, he was able to make full use of the power of compounding to amass this humongous wealth from the stock market investing. Warren Buffett has redefined the world of investing, and in doing so, he has established a set of rules that the investors around the world use to set their portfolios. And in today's video, we are going to have a look at 6 such rules that you can also incorporate in your investment strategy. Rule number 1 is never lose money, and rule number 2, never forget rule number 1. This perhaps one of the most famous quote by Warren Buffett, and it emphasizes the importance of protecting your capital given that Buffett lost billions during the financial crisis of 2008. His first rule of investing may strike you as odd. However, Mr. Buffett isn't suggesting you that you can't ever lose money. He is underlining the mindset an investor should have. Mr. Buffett is known for being a value investor, which means he looks for undervalued companies and buys them at a discount. By doing this, he minimizes his risk and maximizes his potential for profit. In this rule, Warren Buffett is trying to imply, do your homework before investing, don't make a financial decision without knowing what you are getting into, and never say to yourself that it's okay to lose money. The actual rule number 2 is never invest in businesses you cannot understand. According to Warren Buffett, risk comes from not knowing what you are doing. His advice is to only put your money into things you fully understand and can explain. Mr. Buffett regretted not investing money in Google on time because he could not understand the business model. Despite him losing on not being an early investor and losing some good opportunities, he invested only when he understood the company. Moral of this rule is there is a risk in your investment more than usual if you don't know what you are doing. If you research an investment but you still don't understand how it works or what it's supposed to do, just walk away. Moving on to rule number 3, our holding period is forever. Warren Buffett says if you are not comfortable holding a stock for 10 years, do not hold it even for 10 minutes. Once you have studied what you are getting into and made an investment, considering it long term allows you to tune out the natural ups and downs it will experience. When you think of an investment as a long-term commitment, you are far less likely to panic and sell at the wrong time. Fearfulness or greed can make investors act on instincts. They end up buying or selling stocks and destroy their portfolios in long run. Warren Buffett advises against doing this thing. Rule number 4 is price is what you pay, value is what you get. This rule by Mr. Warren Buffett highlights the difference between price and value. Just because something is cheap doesn't mean it's a good deal, and just because something is expensive does not mean it's not worth the money. For example, a stock trading at 10 rupees could be overvalued, and there is also a possibility that a stock trading at 1000 rupees could be undervalued. Warren Buffett looks for value in his investments, which means he's willing to pay a fair price for a company that holds strong fundamentals and good long-term prospects. Next rule is never invest with borrowed money. Warren Buffett says it is crazy to borrow money to invest. If you borrow and invest, your actions would be too tied to need to repay that money, and it becomes difficult to make long-term decisions on borrowed money because you have to pay it back. In such cases, you might end up becoming prey to greed or fear. The important takeaway from this rule is there is no such thing as a sure thing. All investments have built-in risks. If you can't afford to invest with your own money, your best move is to wait. And last but not least, rule number 6 is be fearful when others are greedy and be greedy when others are fearful. This rule by Mr. Warren Buffett underlines the importance of contrarian thinking. When everyone is bullish on the market, it's often a sign that it's overvalued and due for a correction. Conversely, when everyone is bearish, it can be a good time to buy stocks at a discount. By going against the crowd, investors can often find good opportunities that others are overlooking. Warren Buffett also stresses on the importance of controlling your emotions in the stock market. The stock market itself is driven by the emotions of greed and fear among the investors. This rule simply implies you may not be able to time the market, but you can make it a goal to buy low and sell high. Don't get caught up in the hype and do not start following a herd mentality. Well, these are some of the rules that have helped Warren Buffett become the investor he is today. If you also try and abide by these rules in our investment decisions, we would also be able to reap the extraordinary benefits from it. I hope you guys found this video useful and learned something new about new ways of investing in the stock market. Do not forget to like, share and subscribe to the channel. I will meet you in the next video. Till then, take care.